where we should see gold rally to. So if we were to just kind of look at where gold is right now, we should see it run to roughly about 4,700 and then all the way up to about 51, 5,200. Gold's warning us that eventually something bad is coming. I think we're in the last couple chapters of this book before we have a financial reset. And I think gold is kind of the short-term play over the next several months. I think gold could have this very strong rally along with silver and precious metals.
Gold, gold is not necessarily an inflation hedge. It can be. I like to say gold is an uncertainty hedge. Gold is a problem hedge. And when you have problems, gold does well. It's $4,000 as we're talking, as an example.
Gold and silver are entering a pivotal phase of a broader bull market, signaling significant opportunities for investors. Gold, currently around $4,000, is projected to rally to roughly $4,700 and potentially surge past $5,200. This move is not simply an inflation hedge, but an uncertainty hedge. Gold performs strongly when financial and economic risks escalate. Recent pullbacks are natural pauses in a momentum-driven rally, allowing weaker hands to be shaken out while setting the stage for further upside. Precious metals, including silver, platinum, and palladium, are benefiting from strong technical patterns and robust investor interest as money seeks safety amid potential market turbulence. Equity markets showing early signs of weakness may accelerate this rotation, prompting capital to shift into metals for stability and long-term value preservation. Chris Vermeulen, a commodities and technical analysis expert, and Bianco, a seasoned macroeconomic strategist, emphasize that this rally is part of a larger structural setup. They highlight how historical trends, combined with current market dynamics, suggest that gold and silver may continue to rise in both the short-term and medium-term timeframes. Technical indicators, including Fibonacci extensions and bull flag patterns, indicate that accelerated growth will occur once initial pullbacks stabilize. The market is currently in a first hiccup phase, preparing for a sharper leg higher as momentum builds. Investors should monitor equity trends, supply-demand factors, and central bank activity, as these factors will likely influence the pace of gains in precious metals. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Let's go back to 2008. You and I touched on this, Daniela, a couple of months ago when we were going over this.
Yep.
And I was talking about how gold was setting up. So just to set the stage here, the left chart, everyone, is the S&P 500 candlestick chart. It's the weekly chart, and it happens to be the 2007 market top. Just before the stock market fell, as you can see, it fell about 55%. And so we're in this unique scenario. Now, every time the market has a financial reset, it's always for a different reason. No two times are alike, but they are similar. And so the yellow line on here is the chart of gold. Now, if we look on the right-hand chart over here, we can see we've got the S&P 500 hitting all-time highs. We've got gold also outperforming as one of the best assets going forward here. And we have this unique scenario. And what's really unique is we finally have this first pullback in gold right now where we are. We've had this first kind of sharp pullback to try and spook out, momentum traders who kind of chase things late, got in a little bit late. And what's interesting is we saw this back in 2007. We saw a few red bars on the S&P 500 and gold started to pull back. Now, what's really interesting here is when we kind of look at what the other assets have done. So we saw leading up to this, I've got multiple charts layered underneath. This is GDX, the silver futures, platinum, and palladium. And what's interesting is, we really saw this herd mentality, everyone piling into the precious metal space over the past couple of months. And of course, all of these get their first kind of big push to the upside. That's herd mentality. Whoever is open-minded to buy anything in the precious metal space is more or less has moved in, and they're starting to drive the market higher. And what's interesting is if we were to look where we are now on the charts on the right-hand side, you can see we've got gold with its first pullback. We've got a few weekly red bars on the S&P 500. And of course, we've seen the same scenario. And I was talking about this over the last couple of months, really over the last month and a half, saying everyone wants to be in the precious metals space. And of course, you can see the volume and the moves in all of the precious metals complex have been moving up. If people who aren't in gold, more or less bought into gold over the last few weeks near the kind of short-term market top. And so the big scenario here, Daniela, is like, what's going to happen after this? If it's similar to 2007, then if we kind of look at this chart, eventually the stock market will eventually struggle and start to sell off. Gold will keep moving higher. And eventually we're going to see a fairly big move. It's about a 30% move or so in gold, I think, to the upside. And we're going to see miners continue to move higher. Now, miners will probably struggle a little bit because they're a stock stuck in the stock market. And if the stock market is actually going down, gold miners, are stuck in that market. It's like a falling tide. It's going to pull all boats down. So there'll be a choppier, rougher play. The smoothest play is gold, silver, platinum, or palladium because they're a metal. They're outside of the stock market. So it's not affected in this market environment. If stocks sell off, people are actually going to pull money out of the stock market and push it into the precious metals space. So that's kind of where I think we're going to see. And, if I had to compare where we are, this little hiccup on gold and the stock market right here starting to struggle is, I believe, kind of where we are right now. When we look at this hard right edge, I believe we're this circle, and then we're going to see a big leg higher. So, the sentiment and how all these different asset classes are moving right now are kind of the precursor. I think we're on one more big push to about 51, 5,200 for gold, and potentially a lot higher for, silver and all of those as well. I do think ideally, eventually the stock market rolls over and sells off. And as you know, money is always looking for a return. So if people are scared and they're moving out of the stock market, that money from equities is going to go somewhere else. And usually people chase returns. So whatever's moving with strong momentum is generally where that money is going to flow. So it's going to come out of equities, most likely flow into the precious metals space until this rally or bubble, whatever you want to call it, kind of runs out of steam. So I do think it would be, in a perfect world, we would see the stock market pull back. That will create money flow to move into gold to push it even higher. But I do think we can continue to see gold and the equities market move up and sync together. But I do think like the turbo or the nitro is the stock market selling off and people running for safety and then moving to gold. If we were to look at this recent move, like you and I were talking about, when you and I talked, we were talking somewhere over here, and I mentioned we're looking for a discretionary trade in GLD above whatever was 1,317 or whatever it was. But we've played this recent move up, and there was a Fibonacci move up to this target. So we ended up playing this move in gold. But now that we've actually had this blow off phase where everyone really piled in just before it's had this sharp correction, now we have a very clean pullback to gauge where this next upside move is. So based on this giant bull flag pattern, the strength of this rally and the strength of this pullback, we can project using Fibonacci extensions, where we should see gold rally to. So if we were to just kind of look at where gold is right now, we should see it run to roughly about 4,700 and then all the way up to about 51, 5,200. And do I think it'll be a smooth ride? I think once it starts to take off, I think it'll be fairly quick and fluid. It'll ramp up. I do think, as you mentioned, I think this move to 5,000 can be very swift. One of the good examples of this is if we just go to the monthly chart, and we're in this parabolic kind of phase where things go straight up. So we could get a couple green bars, which is a couple monthly bars, and we could be there in no time at all. And from where we are right now, it's only a 25% move, roughly, to that 5,000 mark. So things are going to pick up speed. If we go back, to the 1980s, 1970s bubble. It's hard to grasp this, but again, I think we could have we're like right here. And we've had that first run, we're having that first pullback and pause, and then we're going to explode up. And I think we're going to see all the precious metals take off. So I think that's where we're at. I think it will be fairly smooth until we get, to a top. Then it'll probably have a very abrupt turning point.
Abrupt turning point.
Yeah. So a good example of this is what happens when we get into these crowded plays, these high momentum moves. The best is really just go look at the silver chart. So if we look at silver, we'll just zoom out on this chart here, and you look at these. It's going to load anymore. We're in this parabolic phase. One green bar, we could, be at 5,000 in gold. One more month or green bar, we could be at $5,600 or $70 silver. Who knows? But, you give this chart to a fifth grader and say, well, what should happen next? Over the next couple bars, everybody's going to be like, it's most likely going to come straight back down. So that is obviously a momentum move coming to an end. It's obviously fairly abrupt. What goes straight up in general comes straight back down simply because it's not sustainable. We want something to grow steady over years so that it's moved too far too fast. Profit takers jump in.
Right.
It becomes an emotional trade. And when people pile in emotionally, they also exit emotionally. And it creates a huge sell-off. And that's kind of what we're playing with in the precious metals space temporarily right now. Is we're in this buying feeding frenzy. And this first pullback in gold really is, to me, is just the first little hiccup. The market just trying to shake things up a little bit before we have another big push and go higher. Gold's warning us that eventually something bad is coming. I think we're in the last couple chapters of this book before we have a financial reset. And I think gold is kind of the short-term play over the next several months. I think gold could have this very strong rally along with silver and precious metals.
The current dynamics in short-term interest rates are signaling a growing disconnect between the Federal Reserve's policy targets and market realities. While the Fed adjusts the ceremonial funds rate based on economic data, market-based rates in the repo and treasury funding markets remain elevated due to structural supply-demand imbalances. Quantitative tightening and ongoing government deficits are tightening liquidity, pushing the cost of short-term funds higher despite official rate cuts. These pressures highlight the limitations of monetary policy when funding markets cannot fully absorb government borrowing. The persistent mismatch between policy intentions and market behavior suggests that interest rates remain elevated or move sideways, with broader implications for inflation and financial stability. In this environment, gold and other precious metals continue to serve as a hedge against uncertainty, benefiting from the potential risks and instability in traditional markets. Let's get back to the interview.
The Fed cut the funds rate, and it targets this thing called the funds rate, which barely trades, so it's kind of a ceremonial rate that they cut. And they have all these other tools to bring market-based rates, the reverse repo agreement, interest on reserves. These are the types of tools that they use to make sure that market-based short-term interest rates conform with what the Fed wants. They're not. They're trading at a significant premium above the Fed's target rate, so much so, we're recording about a week after the Fed cut rates. Those market-based rates are at the same rate they were before the Fed cut rates. So the market has not seen a reduction in short-term interest rates. And so there's a signal there from the markets that something's amiss. I think we are looking at two things, because when the Fed sets that ceremonial rate called the funds rate, they're looking at pure economics. How many jobs are we making? What's the level of inflation? Those types of things to make the decision, as they call data dependency, on whether or not rates should go up or down. And they're looking at the data, they've decided that lower interest rates are in order. But the market rates, repurchase agreement, that is a pure supply and demand situation. And what they're trying to tell us there is that the supply of funds to finance treasury securities, that's the repo market, is too small. So what's happening is the cost of that money is going up. Why is it too small? Two things. The Fed's been doing quantitative tightening, so it's been reducing the supply, and this insatiable spending by the government has been growing and growing. So effectively today, we're at a stage where the funding market is not big enough to support the treasury market. And so when you have insufficient demand and too much supply, the cost goes up, and that's why those interest rates are rising. And that's why ultimately the Fed could say, we want to lower these interest rates because we think job growth is weak. Okay, fine, but if the supply demand is out of balance, those market-based rates are not coming down. And really, what I've argued on the stage was the biggest thing that's driving that is the size of the debt, the size of the government. We've asked this question forever, right? When is all this debt and all this deficit spending, when's it going to start to matter? It's now starting to matter. It's mattering in that the funding markets are starting to raising those short-term interest rates against what the Fed wants. I wouldn't call it a crisis. I would call it a concern. But it seems like every day, every week, it gets a little bit worse and it gets a little bit worse. And that's why I tried to emphasize that debt problem that we've always talked about. When's it going to start to come home to roost? We might be seeing the early signs of it right now. So QT, quantitative tightening, so everybody understands, the Fed has this portfolio of $6 trillion of securities. About $120 to $150 billion a month matures. The way they do QT is they say, okay, every month we have 150, I'll use that number, matures. What are we going to do with that $150 billion? We're going to reinvest 110 of it. We're not going to reinvest 40 of it, and we'll extinguish that, and that's how the balance sheet keeps coming down. So what QT has been doing is it's been removing the supply of liquidity out of the market at a time when the government has been growing. So the Fed has acknowledged that there's this funding problem in the market, and so they said that they're going to stop doing QT in December, on December 1st. What I'm arguing is you didn't go far enough, because the problem is getting worse even after you made the announcement of QT. Now, what could they do to fix it? They've got several tools. They could do quantitative easing. That would be that they invent money and buy more securities and expand their balance sheet, to kind of put it in the vernacular. They could offer loans to the market, which is called the standing repo facility. They could buy back treasury bills. That's kind of not QE because it's got no duration. They could change some of the regulatory requirements on the supplemental leverage ratio. They could do all of that. They could do some of that. But let me bottom line it for you. What they would be doing if they did any of that is they would be saying, this gigantic bond market and the funding market can't handle it. We're going to pump up more money in the funding market to handle the bond market. And then you're going to send a signal to Washington, this giant bond market's okay, we can make it bigger, and we can make it bigger, and we can make it bigger. And what is the problem with making the bond market bigger is it's the deficit. When you make the deficit bigger and you add in more bonds, you wind up creating inflation. Because I believe, like a lot of other people, the number one driver of inflation is government spending. And what you're doing by saying to make the bond market bigger is you're allowing more government spending. And let me put this in a perspective so everybody understands. The government spends about $7 trillion a year. That's about a quarter of our economy. Where do they get the $7 trillion? 5 of it they get from taxes. They borrow the other 2. And if you're going to say we're going to take that repo market, make it bigger so it can handle that bond market, you're saying that $2 trillion deficit's okay. Those $5 trillion in taxes is okay. That $7 trillion in spending is okay. And let's do more of it, and you risk creating more inflation. To answer the question for December, the market is putting about a 65% chance that the Fed will cut rates in December. We're a month away from that meeting. At 65%, that is really in coin toss territory. And so it's unclear as to which way the Fed's going to go.
Foggy.
Yeah, foggy, as he would say. I would argue that they shouldn't cut, but we'll have to see which way they wind up going with this right now. I want to make a quick comment about the dissents. I would argue that the biggest weakness that the Fed has is this dictatorial power that the chairman has over the committee, that the chairman gets what the chairman wants, the chairman decides what they're going to do, and everybody falls in line and votes with the chairman, and they allow a couple of people to dissent here and there. This encourages a groupthink at the Fed that has led them down the road of many, many mistakes. Federal Reserve governors and Federal Reserve presidents are technically supposed to be representing the American people. And that's why Federal Reserve governors are confirmed by the Senate. They're not, their boss, if you're a Federal Reserve governor, your boss is not the chairman of the Federal Reserve. Your boss is the American people. And so you should be doing what you think is you're qualified because the Senate approved you. You're qualified to make independent judgments on what is the best thing to do. I hope we see more dissents. I hope we see more, heterodox thinking out of the Fed. I hope, because I think that this will then make it a better organization. So I'm all for these dissents. I think it's a good thing that we're seeing this. I don't like everybody falling in line with whatever the chairman wants. 5 years ago, he said inflation was transitory. Everybody fell in line, and it was disastrous in terms of the outcome of that. And that's wouldn't have happened if we didn't have this groupthink at the Fed. Looking at potentially sideways to higher interest rates. 2 things about that. One, don't be afraid of higher interest rates. They should always trade at where they are appropriately valued, and they might be appropriately valued at this level, if not higher. And the consequences that come from that. The stock market has been running on easy money. The stock market loves that the Fed has been providing it easy money, but the funding markets are telling you that maybe the era of easy money is at least temporarily done for a while right now. And to that end, I was kind of giving them a warning about interest rates, that the Fed might not be cutting them as much. And if they are cutting them, if I am wrong and they continue to cut them, the consequence could be inflation. And that could be far worse than just saying that interest rates will go sideways to up, because in inflation, interest rates will go dramatically up, and other financial markets, like equities would go down. Be positive for gold, though. Gold is not necessarily an inflation hedge. It can be. I like to say gold is an uncertainty hedge. Gold is a problem hedge, and when you have problems, gold does well. It's $4,000 as we're talking, as an example.
Gold and silver are positioning for a significant rally, reflecting broader market uncertainty and shifts in capital flows. Recent pullbacks have created clean entry points for investors as momentum in the precious metals space strengthens. Market dynamics suggest that gold could move toward $4,700 and even surpass $5,200, driven by a combination of macroeconomic risk, stock market volatility, and continued demand from institutional buyers. Precious metals remain outside traditional equity pressures, providing a safer pathway for wealth preservation, while stocks face potential turbulence. Technical patterns indicate that this is just the early stage of a larger bull run, with gold, silver, platinum, and palladium poised for accelerated gains as liquidity shifts from equities into hard assets. The underlying trend is clear. Uncertainty in the markets fuels demand for precious metals. For anyone focused on protecting and growing capital through strategic positioning, staying informed and prepared is essential. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.